Understanding the concept of incurred expenses is vital for anyone involved in financial reporting or decision making. It's one of those terms that, while it may seem straightforward, can lead to confusion if not properly understood. So let's break it down together, shall we? First off, what does incurred actually mean in the world of accounting? In simple terms, when we say an expense has been incurred, we're talking about a financial obligation that a company has created. This means the company is responsible for paying for something, even if that payment hasn't been made yet. Think of it this way: if you order a pizza, you might not pay for it until it arrives, but you've already incurred the obligation to pay as soon as you place the order. The same principle applies to businesses. For example, let's say your company orders $1,000 worth of office supplies. The moment you place that order, you've incurred that expense. You're now legally obligated to pay for those supplies, regardless of when the actual payment happens. This is crucial for accurate financial reporting because it helps businesses keep track of their liabilities and obligations. Now, let's clarify what incurred does not mean. The common misconception is that incurred expenses only refer to cash payments. That's not true. Incurred expenses can also include non-cash items like depreciation or amortization. So, even if cash hasn't left the company's bank account, the expense is still recognized. This is important because it allows businesses to paint a clearer picture of their financial health. Another common misunderstanding is that incurred costs are only recognized once they've been paid. Again, that's not correct. These costs are recognized when they are incurred, not when the company writes a check or makes a payment. Imagine you've just hired a contractor to renovate your office space. You may not pay them until after the work is done, but the moment you sign that contract, you've incurred the expense. Now, let's take a quick detour into the history of the term incurred. It actually comes from the Latin word cur, which means to run. It originally described physical actions, but evolved over time to refer to the occurrence of an event or situation, particularly in financial contexts. By the 17th century, it had made its way into accounting language, helping accountants track all the financial obligations that businesses incur. Why is understanding incurred expenses so important? Well, it ties directly into the matching principle in accounting. This principle states that expenses should be matched with the revenues they help generate. So, when a company incurs an expense, it must be recorded in the same period that the related revenue is earned. This ensures that financial statements reflect a true and fair view of the company's performance. Let's look at a few examples to illustrate this concept further. Suppose ABC Limited orders $10,000 worth of office supplies in January, but doesn't receive the invoice until February. According to the matching principle, ABC Limited must record that $10,000 expense in January because that's when the obligation was incurred, not when the invoice arrived. This ensures that the financial statements accurately reflect the company's financial position for January. Here's another scenario. XYZ Inc. has a maintenance contract for its computer systems, costing $2,000 a month. If the maintenance work is done in February, but the invoice isn't received until March, XYZ Inc. still needs to record that $2,000 expense in February. The obligation to pay was incurred when the maintenance was performed, not when the bill arrives. Now, let's talk about the importance of incurred expenses in budgeting and forecasting. By understanding incurred costs, companies can better plan for future expenses and make informed decisions about resource allocation. If a company sees that its incurred costs are consistently exceeding budgeted amounts, it can adjust its spending or identify areas for improvement. Incorporating incurred expenses into financial planning and analysis can also enhance a company's understanding of its financial situation. By analyzing these expenses, businesses can identify fixed versus variable costs, leading to better cost management and increased profitability. Moreover, incurred expenses play a critical role in decision making. When considering investments or new projects, companies need to factor in the costs they've already incurred. For instance, if a company is looking to expand its production line, it must consider the expenses incurred in acquiring and installing new equipment, as well as the ongoing operational costs. Understanding incurred expenses also helps companies measure their financial performance. By tracking these costs, businesses can assess their spending patterns and identify areas where they can cut costs. For example, if a company notices high incurred costs for raw materials, it may need to negotiate better prices with suppliers or find alternative sourcing options. Now, let's differentiate between incurred expenses and paid expenses. Incurred expenses are those that a business has committed to paying in the future, while paid expenses are costs that have already been settled. When a company pays an invoice, that incurred expense is then recorded as a paid expense. This distinction is crucial because it affects how expenses are reflected in financial statements. So, what about the terms incurred and accrued? While they are related, they refer to different stages of the accounting process. An incurred expense arises from a specific event, while an accrued expense represents amounts that have accumulated over time but haven't yet been paid. For example, if a company incurs an expense for services rendered in June but pays the invoice in July, that expense is incurred in June but becomes an accrued expense until it's paid. Finally, let's address a common question. Are incurred expenses considered assets? The answer is no. Incurred expenses are recorded as liabilities because they represent future obligations to pay. In contrast, assets are resources that a company owns and can use to generate revenue. When it comes to recording incurred expenses, the process is pretty straightforward. First, identify the expense and determine the amount. Next, record it in a liability account, typically accounts payable. Then, debit the liability account and credit the expense account to reflect the incurred obligation. Don't forget to document the transaction for future reference. So, when do companies actually incur an expense? Expenses are incurred when a business purchases goods or services necessary for operations. This can include everything from raw materials and employee salaries to marketing costs and equipment maintenance. Understanding when these expenses occur is crucial for managing finances and making informed business decisions. In summary, understanding incurred expenses is essential for accurate financial reporting and effective decision making. It allows businesses to recognize their obligations promptly and ensures that financial statements reflect a true picture of financial health. Whether you're an accountant, a business owner, or just someone interested in finance, grasping the concept of incurred expenses will empower you to make better financial decisions. So, the next time you hear the term incurred, you'll know exactly what it means and why it matters.